Most people think debt makes you poor, but the rich often use debt to become even richer. The truth is, debt itself isn't always bad. It depends on what you use it for. Some people use debt to buy things that lose value, while wealthy people often use debt to buy things that can make them more money over time. The difference is simple. Poor debt buys liabilities. Rich debt buys assets. A liability takes money out of your pocket every month. An asset has the potential to put money back into your pocket and grow in value over time. 1. Real estate. Rich people borrow money from banks to buy properties. Instead of paying the full price in cash, they use financing to control expensive real estate with a smaller upfront investment. Then tenants pay rent every month, helping cover the loan while the property value increases over time. In many cases, the property slowly pays for itself while the owner builds equity year after year. And as property prices rise, the investor benefits from appreciation on the entire property value, not just the money they originally invested. 2. Businesses. Many wealthy entrepreneurs use loans to expand businesses. Instead of waiting years to save enough cash, they use debt to grow faster and take advantage of opportunities immediately. If the business grows faster than the interest on the debt, they profit massively. For example, a company might borrow money to open more stores, hire more employees, increase production, or invest in marketing. If those investments generate more revenue than the cost of the loan, the business becomes more profitable while growing at a much faster pace. 3. Tax advantages. Debt can also reduce taxes. In many countries, business loan interest and mortgage interest may be tax deductible. That means wealthy individuals and businesses can sometimes lower the amount of income they pay taxes on. This creates more available cash that can be reinvested into new opportunities, investments, or business growth. The wealthy often focus heavily on cash flow and tax efficiency because keeping more money working for them helps accelerate wealth building. 4. Keeping cash invested. Instead of selling investments, wealthy people often borrow against them. This lets them keep their assets growing while still accessing cash. For example, if someone owns stocks or real estate that continue increasing in value, they may use those assets as collateral for a loan instead of selling them. Why? Because selling investments can trigger taxes and stop future growth potential. By borrowing instead, they maintain ownership of the asset while still getting access to liquidity. 5. Leverage. The rich understand leverage. Leverage means using borrowed money to control bigger assets and create larger returns. This is one of the biggest financial advantages wealthy investors use. Instead of needing millions of dollars up front, leverage allows them to control large investments with a fraction of the total cost. When the investment performs well, the returns can be significantly larger because the gains are based on the full asset value. Debt can destroy wealth or create it. The difference is knowing how to use it wisely. The wealthy don't just borrow money randomly. They use debt strategically to acquire assets, increase cash flow, and grow their net worth over time. That's why understanding financial education is so important.